Let's bring on board Satyanarayana Chava. He's the founder and CEO. Mr. Chava, thank you for joining in on ET Now. Let's talk about the fact that, over the past 3 years, Laurus has managed to make meaningful investments in capacities with gross blocks, which are yet to generate revenues. So will FY20 then be a year of all these gross additions or units leading, growth for the company?
Absolutely, you're right. In the last 3 years, we invested significant capex into 3 units. So all 3 units will give positive cash this year. See, this is the year of transformation at our company. All growth divisions are yielding significant revenue as well as positive cash. Especially formulations, as you have seen. Q1 we did more than 1 billion rupee sales. That is the first. From 50 crore last year, we did 100 crore in Q1. And we have wealthy order book, not only in formulations, but also in API and custom synthesis.
The company turned around its EBITDA margin from 15 to 17%, but now again in the first quarter, margins has gone below 16%. So, I mean, is it because of the the rise in raw material costs?
It's not the problem of gross margin in the sales. Gross margin in the sales, in fact, increased. It is because of we did production, so OPEX went up. And other expenditure also went up, but sales moved from Q1 to Q2. Otherwise, if you look at the overall gross margin on the sales what we did, gross margin percentage went up by more than 2%. So that is a very good thing to understand. Business is looking better. We even de-risked the supply chain challenges coming from China for our key intermediates. So gross margin, in fact, are very healthy, increased by more than 200 basis points.
There's also a strong ramp up in oncology APIs because of the new launches. So does that continue to be, Laurus's leading growth drivers?
So our leading growth drivers will be our formulations, followed by our custom synthesis business. And we expect growth in API business from Q2 onwards because of some tender results and supplies were not happened in the Q1. So the leading growth driver will be our formulations, followed by our custom synthesis, and then our API business.
There's a sharp pickup seen in formulations and synthesis businesses. Do you expect that momentum to continue in FY20?
Actually, will accelerate further. So we have order book more than what we achieved in Q1. So looking very good. Actually, the growth will be much more accelerated in Q2 onwards for formulations and also in custom synthesis.
What was the performance of ARV APIs? Because in FY19, it's all decline in sales. So does that business continue to be under pressure?
It is a bumpy business. We can't estimate the ARV business quarter on quarter because of the very bulk of sales we do. But if you look at the order book, what we had in API business, bulk of it is ARV business. So in the year overall, we expect to do very well in ARV business too. So as a franchisee, we will cover up this shortfall in Q1 in the coming quarters.
So can one safely say that the capacity expansion is now behind the company and there's no other major spend in FY20 apart from, your regular maintenance?
There is some capex, but it is not significant. Even there is money, we are not in a position to invest because we don't have any requirement of huge capital expenditure in FY20 and the year after as well.
Okay, on that note, Mr. Chava, thank you then for joining in.